So, welcome to the Markets Unscripted podcast. This is the very first episode. I'm your co-host, Matt Caruso. I'm here with my other co-host here, Jason Shapiro. Jason, how you doing today?
I'm good, Matt. How are you?
Good. So, really looking forward to this new format. We get to kind of talk about things going on in the market, but not just kind of the surface level discussions you see everywhere else. We're really going to be able to kind of dive in. We have different backgrounds, but interesting getting to know each other. We kind of understand that getting to the heart of trading, there's those core truths that are true, whether or not you're doing a reversion to the mean, whether you're looking to follow trends. And so kind of trying to get a good idea of what's going on in the market from the lens of someone actually implementing through a system. So looking forward to doing that here with you.
Should be fun.
One of the things I want to talk to you about here, we kind of get kick off. I think the main topic to discuss right now is the whole AI trade and how all of that has been kind of unfolding. I think what's really interesting is we saw the weakness come in. A lot of that was built up with all the talk of AI as a bubble. There was the Burry short where he supposedly bought puts, which now we find out he's also closed his hedge fund or he deregistered his hedge fund. And at the same time, ironically, after the Friday bell, what we got was news that Berkshire Hathaway, the longtime stamp of approval for value-oriented people, bought a $5 billion stake in Google. At the same time, Google went out and spent more on CapEx, $40 billion in Texas. So very interesting to see after all of this kind of bubble talk that, where I think probably in some ways, the bulls are actually hoping for a bubble, and the bears usually are the people who kind of missed a lot of the uptrend and kind of just don't believe in it and are hoping to see it kind of come down. This is kind of really interesting because now we're actually seeing some market weakness, but yet kind of the news that came out is also positive for the AI trade. Like, what are your initial thoughts on all that came out with the Buffett investment within the AI trade, Jason?
I'd say like most market narratives, I found it to be funny. It's because we've been hearing for the last month about how, Buffett is in cash and he has got all this cash and that is an indication that the market is overvalued and yada, yada, yada. And that's all we heard. And now all of a sudden we hear they're investing in Google. I think that's funny, if nothing else. I also think it probably has nothing to do with Warren Buffett. Warren Buffett is retired, He's not even, he said a couple of weeks ago, he's not even writing the quarterly letters anymore. He's not doing the shareholder meeting anymore. He's like 98 years old or whatever, I don't think he's the one that's making these decisions, right? So if you're trying to look at what Warren Buffett is doing, he's probably, having a nap, Now you can say, okay, but the people that will take over for him are trained by him and are trained under the same thought process, and that may be true. Although I think that we have found that they have made a lot of investments that are not Warren Buffett type investments. I would not call Google, and this isn't to say that the Google stock can't triple. It could, but I would not call Google a Warren Buffett type of investment. So I think it's silly, and there's also the possibility that these guys are FOMOing as well. They're just as guilty as anybody else into doing that type of stuff, of trying to do that. I mean, if you're sitting on all this cash and you're watching the AI economy, take over the world, it's like at some point you probably feel like you need to get involved. Otherwise you feel a fool. And so they got involved. So good on them. Wouldn't it be the most ironic thing if they ended up top ticking it? I don't care what anybody says. Everybody's just as susceptible to the same errors as everybody else. I don't care if you work for Berkshire Hathaway. I don't care. I don't care who you are. We're all human beings that suffer from the same frailties and the same behavioral biases. And that could be the case as well. I don't know. I think that anybody who tells you they know what this AI thing is going to look like and 5 years from now, is fooling you and fooling themselves if they really believe that. I think the range of outcomes is so incredibly wide that to say that you know what this is going to look like is somewhat ridiculous. There's a pretty decent, at least for a person of my level of understanding, which is very low, a pretty decent story I thought on 60 Minutes last night. And the guy makes a point where AI clearly can be this miracle, right? The power that's involved in it is incredible. The speed of the computers and the compute and all this is It could be world changing. They could cure cancer. They could increase the lifespan of human beings by 100%. It could do all these things. But I think the point he was making was equal to the good it can do is the bad that it can do is just as equal, right? Um, and they were showing some some pretty scary things about, Skynet, essentially, which is the day the computers took over. They run these
Yeah.
simulations, and some of the simulations were ending up in some pretty scary places. You
Well,
know,
I think that's the problem when it comes to investing is people tend to end up wanting to cheerlead for their side. So if you think AI is like the tech revolution and it's going to be everyone's going to get rich, it's like you can only see the good side that's going to come out of it. And then likewise, I think a lot of people and I've been in those shoes sometimes where I saw a trend developing. I kind of dug in my heels, like this doesn't make sense. The valuation's wild. Like I remember when the all the marijuana stocks started to take off and they took off first in Canada because that's where the decriminalization was starting. And like they had nothing, but these stocks were ripping. And I remember early on, like I caught so little of that trade when it was like my backyard and I should have not actually in my backyard, but I mean it was in trading in Canada. I should have captured a bigger part of that because I kind of approached it with a negative mindset at first. And then I just missed so much opportunity. So I think a lot of people have been locked out and then it's easy to kind of lean in to the narrative like, oh, it's not as big as they thought, or they can't afford the capex. I just find that a lot of people have been reaching for an excuse for a reason why these stocks have to go down. I find the irony of that is, by saying that, they can't afford the capex and all the rest, it's like, the very same companies everybody loved to own, the Mag 7, all of this time, like suddenly the argument then shifts that these same group of people don't have the capacity to kind of plan out capex and make a decent forecast with all the data that they have and all of the rest. Like part of my view is I think a lot of the weakness we've seen recently, and I'm sure that this is something we both track, is I've been seeing kind of like liquidity in the market starting to kind of drain. I don't know how much of that is based on the government shutdown or just other kind of like factors, the Fed, always talking a little more hawkish or whatnot, to what degree that has an impact. But I think my view is, stocks got a little bit stretched. There was the Burry argument that he's shorting these stocks and that the capex is not going to be able to be financed and the Oracle bonds are not trading, at the best levels. And it's like these stocks are done. We're in a bubble and it's over. Which I find that's the other end of the extreme of the argument. I understand, like at some point, especially the smaller companies, they can maybe get ahead of themselves. But interesting to see with someone, even if it's not Buffett, but coming from the value discipline, it's hard to kind of argue that, again, these companies, though, are like way overspending and they can't even support the capex and it's a big kind of house of cards that'll crumble. So it'll be interesting to see what happens. I think it's interesting that I think a big driver is we're kind of colliding with some declining liquidity from the measures I look at. So I think maybe that's kind of putting pressure on things. But once that kind of passes, it'll be interesting to see what happens next. And with Powell soon to be out the door and with his successor chosen, it'll be just interesting to see how markets react when that comes about. Is there something specifically you're watching for, Jason, that you think will be an important next tell?
personally, I believe it's all liquidity.
Mm-hmm.
Okay. Because that's money. What makes markets go up is money goes in, and what makes market go down is money comes out. Right. I think it's all liquidity, and I agree with you that we are seeing signs of liquidity drying up some here. Um, the thing about liquidity, there's a lot of different ways to define it, but if we just keep the simplest definition, which is, let's say, M2 money supply, right?
Mm-hmm.
M2 money supply is going up, it means liquidity is going up. M2 money supply is going down, it means liquidity going. Okay, that's the simplest definition. But forget about the calculation of how many times that money supply turns over, right?
Mm-hmm.
That's the real
Right.
calculation, right? And we don't know that until after the fact, right? GDP is essentially money supply
Mm-hmm.
growth times velocity, right? Um, we might be able to track the money supply growth, but we can't track the velocity until after the fact. If you double money supply growth, but velocity halves, then you got nowhere, right?
Mm-hmm.
So it's all a question of velocity, in my view. Um, and that's not something they can control. They can print as much money as they want. We get that, and they're not going to stop doing that. There's no way that they're going to stop doing that, in my view, because they can't, because that's the whole thing and has been the whole thing. And if they stop that, then we're all going down. And they can't have that. As much as it's probably would be the best long-term solution to things, that the people that have to get elected into office are not going to allow that to happen. So they're going to keep this liquidity tap going. But so if we can't really know what liquidity is because we don't know what velocity is, then how do we know if liquidity is drying up or not? And the way that I try to look at it, just like I try to look at everything, rather than me forecasting the future or me coming up with the genius answer, which I don't have, I let the markets tell me, right?
Mhm.
And look, the number one market, in my view, to measure liquidity is crypto, because that's all crypto is. There's no value there. I mean, I'm not going to get into this argument. You can argue that, okay, Bitcoin has some future value, some future intrinsic value, maybe even some present. I don't know. ETH maybe, but a lot of these coins, I think, have no intrinsic value, never will have intrinsic value, don't even pretend to have any intrinsic value, right?
Right.
And yet they're not at zero. The fact that
Mhm.
they're not at zero means that it's liquidity driven. So that stuff clearly is having a rough time here, right? And you can tell me, okay, it's just temporary and Bitcoin's going to 1 million and all. Okay. I'm not in a position to argue with you. Um, I'm a tape reader. What I'm telling you is right now, this stuff trades like crap. And if that is a function of liquidity, which I would argue it is, then liquidity is drying up, right? You have Japan rates going up a lot. So it's that whole carry trade thing kind of going away. Um, and I also think that the liquidity thing is very, very dependent on Donald Trump. Right? He has told us that this is what he's going to do, right? He has told us that the next Fed person that he appoints is going to be very friendly to what he wants to do. We know that Donald Trump only appoints people that are very friendly to what he wants to do. So we know that the incoming Fed chief is going to be a person that wants to do this. We know that.
Mhm.
Um, so Donald Trump's ability to do his thing, that this stuff is very dependent on that. And I don't know, again, the future of anything, including the future of Donald Trump's popularity. But from what I'm seeing, at least, and I'm sure it's just fake news coming out of, coming out of MSNBC or whatever, which I don't watch. But, the polls are going south on Donald right now.
Mhm.
Right now. Doesn't mean it's
Mhm.
going to always be that way. But right now, the polls are going pretty far south on Donald. Um,
I think that's why
and
he had tariffs on some of the key commodities just on Friday after the bell, which should be another bullish leg. I think it was on beef and coffee, and I forget which other ones. I think it
I mean,
already is attempt to kind
this is
of.
a whole nother conversation, which I'd love to get into. But yes, he cut tariffs on coffee on Friday,
Mhm.
and coffee went down and closed up on the day.
Mhm.
Why do they close up on the day? And now it followed through to the upside today. If it ain't going to go down on him cutting tariffs, when is it going to go down? Right? I mean, this is the magic of markets, right? In my view. I mean, that's a funny question too, because we were told that tariffs do not cause inflation. That's the coffee reversal on Friday. You see that
Yeah.
green candle, right? And it's
Yeah. Yeah.
following through to the upside today. So, if tariffs don't cause inflation, then why does lack of tariffs help inflation? I'm having a
Well,
hard
to
time
to to
understanding
be
that.
fair, I think the only way I would look at it that would, because obviously tariffs have an impact. I think if there's a domestic alternative, the impacts will be less, and it could also, promote competitive pressures inside, outside, whatever. But if there is not enough domestic supply, like I said, there's not enough. Obviously, I don't think there's too much coffee growing on in the U.S. outside of maybe Hawaii, and there's limited beef production. Like in those cases, if you put a tariff, like there has to be a pass through because there's no domestic substitute. So I think it really depends on. That's why I think blanket tariffs, even if you want to argue the case for tariffs, obviously stuff that can be produced domestically, there's some case to be had if there's like national security concerns and the rest. But just things on like coffee, for example, I mean, there's obviously going to be a direct impact on prices, right?
And yet they cut the tariffs and coffee prices went up on Friday and have followed through to the upside today.
Which is interesting.
Right. So anyway, getting back to the original point, which is that I think it's very dependent on Donald Trump, and now he's having problems. And again, I don't know what it's going to look like in a month or
Mm.
6 months. But now some of his friends are turning on him, right? That woman from Georgia, you know, um, has turned on him. Now he could probably bury her. Okay, Donald
Mm.
Trump is just the king of that, right? He's the greatest politician alive. I would argue. And so he can probably bury her politically, but maybe not, and if he starts to lose support, and he can't push through these policies that are, so liquidity friendly, then I think that we could be in a lot of trouble because, in my view at least, this whole thing has been about liquidity. Really, since '08, the whole thing's been about liquidity. The rest of it is just is a ghost, right? Um,
Well,
the
one thing like I
economy,
would pivot to as well, like the liquidity is important, but I find sentiment's also critical. And I don't know if you saw the AAII, the American Association of Individual Investors, is something you track.
it is.
There's a tremendous amount of pessimism. Like this is as of last Wednesday, so before we saw the real weakness on Thursday and Friday, you
Yeah.
already had almost 50% bears. There was a really interesting tweet. Let me just bring it up here really quickly. Someone I like to follow here, Ryan Dietrich, and he says, there's only 3 times in history the AAII bears outnumbered the bulls by 10% or more for the full year. That was 1990, 2008, and 2022. All were bear markets and bad years for investors. This is the first year where we're on track to do that, but markets are up. Is it the most hated rally ever? There's something I found, and which liquidity is important, but I feel like it's the sentiment that will drive valuations to a certain extent. If there's enough liquidity, but if the animal spirits take hold, I can always exaggerate things up or down. But it seems like there's something, and with this whole AI as a bubble and all the rest and the Burry, it seems like things broke so quickly because there's like this pervasive negativity, this pervasive negative bias. I don't know if it's all the guys who were, all in on crypto in 2021, they got blown out. And now they're, this negativity has been kind of instilled in them to some degree, or what. It's an odd amount, especially when you look at something going back to the, decades of consistency. I'm curious how you kind of reconcile, even for yourself, because, I know you like to look at positioning, something I look at too with liquidity. And then it's like, we have to follow the tape. The tape is softened for sure. But then I see 49% bears with markets like single digit percentage points from all time high. Like, how do you reconcile that?
I think bear buyers by people, first of all, because people my age who were trading in the late '90s and were making money hand over fist, and then basically lost it all in 2000, have promised themselves they're never going to get caught up in that again, right? So they're not going to participate in this bubble, right? And then you have the younger people who got caught up in 2021, right? The post-COVID bull market, and got burnt pretty badly, right? Which was just the same thing all over again. Just the next generation falling for the same play. So they got burnt badly. And so now they don't want to get caught up in that again, right? What they got hit in 2022. So they're not going to buy this bubble. And so I think that's what it is. And the market being a discounted mechanism, it can't be a bubble if everybody's not going to chase it. It's a bubble because everybody chases it, right? It can't be one if one is the other, right? It's reflective, as Soros likes to say, right? One is the other. It's only a bubble if people are super involved in it. It can't be a bubble if they're not super involved in it, right? So that's what's been this whole hated bull market and why it continues to go up, despite the valuation concern. But I have been debating this in my own mind and sort of in my weekly stuff that I write for a while now. How does that end, right? The classic ending to that is everybody capitulates, right? And the thing goes through that last crazy up phase, right? And then that becomes the top of the bubble. Okay. I don't think that's how it ends this time. Doesn't look to me. There was a time when I did think that was how it was going to end, but I no longer think that's how it's going to end. This last summer, I was saying I thought that was probably the highest probability of how it ends. But now I don't see it because, again, it's discounting mechanism. Everybody knows that's what a top looks like. Nobody wants to be the person that's caught in that. So nobody is going to do that, right? They're not going to capitulate if the stuff keeps going up. We see it, just like you just said. Look at the sentiment. As the market goes up, the sentiment gets worse. We've almost never seen that.
Never.
Right?
I've never seen it to this degree, even myself.
No.
Like just studios, I've never seen this kind of dynamic.
So I think that's why, because nobody wants to be that person. And as long as nobody wants to be that person, it's never going to happen, right?
But in this case, it's the crowd, right? I mean, do you join the crowd? Because that's
no,
like
there's another way that it could happen, right?
Right.
Which we haven't seen much, but I have seen quite a few times across. I trade a lot of different asset classes, and I trade market turns. So I've seen turns that have looked like this as well. The market could come down 10%,
Hmm.
right? And then people can buy that dip that they've been waiting for. And then the sentiment can change where they can get bullish because now they're getting a chance to buy that dip. And
Hmm.
then they can get fully in. And then the market can really go down. That's the other way that this can happen.
Hmm.
I've seen that a number of times. Not a lot, but I've seen it. It certainly happened in COVID. If you go back and look at what happened to the stock market in COVID, the first 2 weeks or so, the market came down some. People bought that dip because at the time we didn't know that COVID was COVID. We thought that it was bird flu. There had been a number of bird flu scares in the years leading up to that that ended up being nothing, right? And so people thought that's what it was again. So they bought that dip. And we saw people get very bullish after the first 2 weeks and very long after the first 2 weeks of COVID. And the market held for a couple weeks, right?
Right
And
here, I think you're
then
talking about, right?
right there.
Yeah.
And then after they all got long, I wish you had the COT data for that, but
Hmm.
you would see that they weren't very long at the top. They got very long into that dip. And then we had the real move down because now you
Hmm.
have people that are way too long. So the market can go down, right? It's all about this positioning thing. It's all about money in, money out, right? So that was how that went down. So that's another possibility for how the market can top. I'm not here to say the market's topping. I'm not here to be bearish. Okay, I'm just saying
Hmm.
that these are ways that it can happen. So
Well,
just
for
stuff to
one
be
thing
on
that
the
I
lookout
always
for.
one thing I always follow is every cycle that because I've always been equity focused, even though I used to make markets on gold and oil stocks, but I was always equity markets and every market cycle. So I started trading pro in '08. I was trading before that, just like retail my accounts and stuff. But every market cycle has its theme. Um, it could have been there was the rise of China, was the commodity trade in '06, it was oil, it was copper, and then after it was gold after '08, '09 when QE kicked in, and then it kind of always kept kind of always there's always the in thing, and for it's very rare to see the cycle end before the in thing goes through its climax top. But again, it's different this time in terms of sentiment won't buy it. I remember it was 2011. I'll never forget. I was at the desk and a friend of mine came in, one of the other traders, and he's like, Matt, he's like, I hope you had you made good money trading the gold stocks. I was at the gym. I heard two guys talking saying, hey, if you want to make good money, all you got to do is buy junior gold miners. I swear to you, I think that was like days from they're still not at that level, even though gold's gone to north of $4,000. So the it thing of each cycle tends to climb it. Like, did we see climaxes recently in October? Like some stocks had some pretty hard moves. I think it's hard to kind of argue that they were climaxes, like or widespread climaxes across, especially the larger classes. So that's the odd thing. Like, again, we don't know what it's gonna be like. The tape is softened. Because of my measures, like I was lightening up and thankfully so, because some of the stocks I had broke worse than I thought they would. So it's always good to be lighter ahead of that. But so I think you have a good outcome. The way you're looking at it. Something else I'm looking at is I don't know if you've ever looked into the South Sea bubble, like back in I forget what years it was there when. And there was Isaac Newton, one of the. It's funny, it's such a great story. And to your point that you brought up before about how the guys at Berkshire can get it wrong. They're people like anyone else. So Isaac Newton, one of the geniuses of all time, and he was long the South Sea Company, made good money. He got out when he thought it was reasonably expensive. Then it went parabolic vertical, and he ended up, I saw all of his friends get rich. He got in at the top, and then after it broke, and he ended up going broke on the process. And even though he was, an acclaimed genius, so I don't know if we're in that type of a situation. Nvidia earnings are on Wednesday. We're going to see, they're the bellwether of everything right now. They're the big daddy, so we're gonna have to see what they kind of do. But I would find it would be probably it would have to go down in the history books of something that I have to study of how stocks climaxed with majority of retail bearish. It would be the outlier. So we'll have to see how that kind of progresses, I guess.
Yeah, it's like you're saying, yeah, there has to be a climax based on the current narrative. But what is to me, the most popular current narrative is that this is a bubble,
Hmm.
right? We've never seen that before, right?
Yeah.
I was there. Nobody in '99 was calling it a bubble. All right. It just wasn't. It was a new paradigm. It was the classic bubble stuff, right?
Yeah.
Everybody wants to call it a bubble this time. It's like, the people are saying there's a bubble in bubble talk, right?
Hmm.
But are they going to buy the first dip? To me, that's the question, right? They say that it's a bubble. They say that it's a bubble, but are they going to buy the first 10% dip, the first 15% dip they can get their hands on?
Hmm.
Maybe. And we don't know. That's why we monitor, And I think that to your point of said a couple minutes ago, all of this conversation we can sit here and pretend it is super interesting, okay? And it's interesting. I find macroeconomic to be an incredibly interesting subject. I also think in terms of trying to make money in the markets, it's 100% useless.
Yeah.
Okay. So, and I've gotten more and more and more and more that way, right? I mean, I got it this morning from a good friend of mine who has been in the markets longer than I am. He's 12 years older than I am. He was a chairman of the gold exchange for 20 years, and he's been involved in markets for a very long time. And he sent me this text about somebody that was making this thing about the Japan thing, and he said, "What do you think?" And my answer was blah. Because I'm so sick of it. Like, here's the thing that's going to crash the market that nobody is seeing yet.
Hmm.
Okay. You know, we hear that every day, man. There's no such thing. All right. I'm sorry. And it doesn't mean the markets won't crash. Maybe they will. Maybe they won't. The important thing is what you said. The stuff that I was in started to act poorly, so I got out.
Hmm.
Period. Right? If you're trading a process, the name of the game here is to make money. Period. Which means you're trading, I don't care what you're trading your process is, but you're trading a momentum process, right?
Hmm.
Okay, well, if the stock's breaking out, you're long. And if that breakout fails, you're out. I don't care what AI is going to do in 5 years. I don't care what Michael Saylor does. I don't care what Warren Buffett does. I don't care what Jason Shapiro does. And I don't care what Matt Caruso does. Okay? I care about what am I playing? Is it doing what it's supposed to do? And if it is, I'm riding it. And if it's not, I'm getting out. That's what this game is. The rest of it is a bunch of bullshit. Okay? It just is. All right? We are not going to outthink the market. We can sit here and we can, for lack of a better word, sit here and do our mental masturbation all day long. Here's what I think AI is going to do. Here's what I think AI is going to do. Who cares? Here's what this guy thinks it's going to do. Here's what that guy thinks it's going to do. Who cares? All right? What is the market doing and how are you going to make money doing it? That's it. And when it's going your way, ride it. And when it stops going your way, cut it. The rest is just a bunch of
Well,
crap.
yeah,
Understanding
you
maybe
bring up
some of the macro stuff behind it so that you can know how the market is reacting to that is important. But trying to predict that stuff, not only trying to predict it, trying to predict it better than the whole world can predict it, it's just it's a waste. It's a great conversation and it's interesting and it's fun and you know what I mean? And a cocktail party, it makes you sound very smart. But it's got nothing to do with making money, and that's what we're trying to do.
No, but you bring up a great point because I tweet less and less on X because the back and whatever it is, there's always someone with a negative comment or whatnot. I find it exhausting. But what I find interesting is everyone will always kind of root for their stocks as if it's like their favorite sport team. Like if you like the Yankees, whether it's a bad year, a good year, you gotta love the Yankees and we'll turn it around type of things. Which I for me doesn't make sense. There's William O'Neill who I've always studied and one quote that I've always loved from him and I write down as often as I can is the only good stock is a stock that goes up. So like I think that's the right mentality you have to have. But to do that, and to your point, you have to be able to kind of whittle away from all of the news, all of the stuff that's out there to figure out what works for you. So, for my process, I have, like I said, I like to look at liquidity. I'll bring up the different tools that I follow. I'll look at the number of stocks making 52-week highs versus 52-week lows. I'll look at how the junk bond market, the yield on junk bond stocks are going to be doing. Those are my like liquidity type of tools. I have tools to figure out kind of positioning that I like to look at, what I call my FOMO indicator. I know you like to use the COT data, and that's your main thing for positioning. What's your process, especially, we can go to there's going to be many episodes, we'll go more into other like specific tools I look at, but for yourself, where I know you look at the COT for positioning, but then after you're always going to kind of weigh that against the tape and whatnot, like you're saying. For someone who's like looking at this and you want to say, well, how do I start to look at it from that lens? Because everyone wants that perfect indicator, which doesn't exist. But when you're trying to look at it, how do you say no to all of the information that is useless and is opinion and all the rest? What's your process to find that signal to say like, okay, now the market's behaving better, which news is relevant? Like, what's your process for looking at that? Because right now, I think we both agree the tape has turned soft, whether it's AI, whether it's already other stuff was already soft, so that AI has kind of joined the party of softness. But with the negative sentiment, there's enough, I think, fuel to cause a year-end rally, but we want to see the tape improve a little bit. What would be that improvement of tape for you that would kind of show that change?
The market has to act better, man. I mean, look, how do I do it? First filter is I'm looking at the positioning and I'm looking for extreme positioning because I trade market turns because I find that's where the best risk reward is for me. Okay. Doesn't mean for everybody, fits my personality, fits what I do. So everybody's super short, according to the COT. Vast majority are super short.
You're talking
So I'm
retail
looking
or
at
commercial?
I'm talking what they call speculators in the
Okay,
COT market.
large specs. So for those who don't
And
know the COT,
it's
usually
all
you want
spec.
to be with the commercials and not with the speculators. So the
I don't know
speculators
if
are
you
short.
usually want. I don't know if you usually want to do that, but I think at market turns you want to do that.
Okay, okay, fair
And
enough.
even then, not always. Less than half my trades actually work, but it just gives you a good risk reward profile, right? So that if by some miracle the trade actually does start to work, then all those people can get squeezed, right? Anyway, so once that's there, now I'm looking to put a trade on. Now I need the tape to confirm it. What does that mean? Well, the coffee thing we talked about is the perfect example. Now, I don't have speculators mega short coffee here, so I can't put the trade on. But let's go for a second. Just imagine that I did have speculators mega short coffee here. Okay. They come out and they say they're going to lower tariffs on coffee because they want to get the price of coffee down. This has worked. Okay. They said they wanted to get the price of soybeans up. It worked, right? They said they wanted to get the price of beef down. Look at live cattle futures. It worked. Now they come out and they say they want to get the price of coffee down. So they take away the tariffs on Friday and coffee closes up. Had coffee been max short and my stuff, I would have bought coffee on the close on Friday. All right. It cannot go down anymore on what would be incredibly bearish news. Are you telling me that nobody saw that news? It was headline news. Anybody who's involved in the coffee market saw that news. Trust me, right? You see, that's where Trump came out. That's
Sorry,
the
that was
cattle,
live.
right?
Yeah, let me
Right.
bring
So
up.
you see where he came out and said he wanted cattle prices to go down. It was
Yeah.
that first big red bar.
Oh,
The
sorry.
first one.
Let me bring back cattle. This one here.
That's coffee. Yeah, right there. That was when he came out and said he wants the price of beef to go down. So in this particular case, speculators were very long coming into that. So there was a good chance that it was going to follow through down. But regardless, that's how I do it. If coffee were set up yesterday or Friday, I would have gotten long on the close. But I know most people out there are going to be trading coffee. I'm here to say that it doesn't matter what you trade. Everything trades the same way. It doesn't matter if it's coffee or the S&P or bonds or currency or live cattle or whatever. They're all the same, right? Everything trades the same. So look at the stock market. We had Palantir earnings come out, right? I think we can agree that AI is one of the main drivers of the stock market here, right? I think we'd be crazy not to agree with that, right?
Mm-hmm.
I think we can agree that Palantir is a major AI play, right? Well, they came out with earnings that blew the field in every single way. Current earnings, current revenue, forecasted earnings, forecasted revenue, demand was insatiable and the whole thing. And Palantir stock went down. That's a bad tape. That's a bad tape. And since then, the NASDAQ has been underperforming. The NASDAQ should not be underperforming. Okay. The NASDAQ should be outperforming in a bull market, not underperforming. And to this point, it is underperforming. It looks like it's trying to turn around. It kind of turned around Friday. And it's sort of turning around today. It's trying to outperform a little bit today. But one of the best things I find over time, not every time, like you said, there's no magic thing that works all the time, right? But if you're playing odds over time, the odds are you want to be long the stock market when the NASDAQ's outperforming. And when it's not outperforming and it's underperforming, you want to be careful, right? So we've been underperforming ever since that Palantir thing, right? So that's a bad tape. So your question was, well, how do we know when it turns around? Well, we know that it turns around when things start to act better. Let NVIDIA earnings disappoint, which almost seems like it's against the will of God at this point. But there is always the possibility. Let NVIDIA earnings disappoint. It would be very hard for that stock to go up if it disappoints, but let it disappoint and let's see how the markets trade. I always say it's not about the news because you're never going to be able to predict the news unless you have inside information, right? It's about how the market reacts to the news. That's what's important, right? So let's see how NVIDIA comes out and let's see how the market reacts. And then we maybe can get a better feel, right? So that's what I think you look for, well, when are things going to turn around? The sentiment thing, I think, is a little bit dangerous here. As a person who has been following and trading off of sentiment mainly for a very, very long time, it's just like anything else. Now everybody pays attention to this. Now everybody's talking about how bad the sentiment is, right? This does not tell you where people are positioned. This is calling up 200 freaking guys over the age of 50 years old and asking them what they think. That's all this is, right? this survey, I pay attention to it. I paid attention to it every week for years and years and years. Okay, but it's not that great. And the more it's discounted in, the less relevant it is, right? And now everybody pays attention to this thing. Like it's all over Twitter, right? Everyone's talking about this. Your boy, what's his name over there? Who you pointed out to, is pointing out this stuff. And
Oh, yeah.
that's great. And I like that guy. He seems like a nice guy, Ryan Dietrich. But the truth is, Ryan Dietrich also pointed out, just like everybody pointed out, that September and October are two of the worst months in the stock market, right? And November is the best month in the stock market. Well, September and October ended up being two of the best months this year. And to this point, November's been the worst month this year, or one of the worst months. It's probably not as bad as it was in May or whatever, but it's off to a pretty bad start. Because again, the seasonality thing, if everybody is paying attention to it, then it's discounted in already. All the people that were bearish after the bounce that you've spoken about, they didn't want to get bullish in September and October. They wanted to wait for the inevitable pullback for those months to then buy. Well, it never happened, right? So now they had to chase. So now that they probably chased, again, now they're in, and now they know that November and December will be positive. Well, watch. Now November and December will be negative, right? Just for that reason, because one is the other, right? One is the other. Everybody always wonders, how come everything I do in the market is wrong? Well, it's because you're doing what everybody else is doing. So there's no edge to what you're doing, right?
Right.
And to me, this is the same example of that, right? And especially now with Twitter and with so many people involved, this kind of information gets discounted in so quickly now, right? That it becomes irrelevant very, very quickly. And that could be exactly what's happening with the AAI thing too. Could be. I'm not saying it will. I'm not a mega bear or anything like that. I just think right now the market trades like crap, but I don't believe that the all-time high for the stock market is in, knowing that I could be wrong about that as well. But I don't necessarily think it's in. I just think we have a little bit of work to do here, and we need the market to act better.
I hate to put anything to say like this has to happen or this or that, but I think in the short term, at least what's going to be guiding me, I've already like lightened, but whether I have to get even lighter is going to be one, the NVIDIA call and the reaction, but also, Google's reaction. Google's up on the whole Berkshire thing. It's already hit new highs, already faded from there. Is it AI that's overdone? Is it that there's liquidities coming out of the market and that's just, sinking all the boats? We'll have to see. But I think the combination of whether or not the NASDAQ can hold the lows of Friday, whether Google can hold this gap, and how NVIDIA reacts, I think those in the short term is all you really need to know to understand whether or not you should be stepping on the gas or the brakes. That's the way I look at it, and that's what I'm going to be using to guide positioning even further. So we'll have to kind of see from there, I guess. I don't know if there's anything else that you're watching specifically. I think that you think people should keep an eye on, but those are the three that I'm going to be watching closest.
No, I think those are the main things as far as the AI driver goes. The main things, and I think the other thing is the liquidity thing. You have to be watching these markets that are functions of liquidity, like Bitcoin, and look what Bitcoin's doing. And can it turn around in a day? Yes, it can, but it hasn't yet. Okay, it hasn't yet. Bitcoin continues to trade like crap. It has traded like crap since the 10th. Right, when they had that big day, right? The fact that it didn't rebound from that big day. What we heard on that day, when you talk about people who are rooting for their favorite team, there's nobody more guilty of that than the Bitcoiners. All right,
100%. It's hodl forever, never sell.
Right, and it's fine. I'm not here to say that Bitcoin ain't going to 1 million. Maybe it is, and I hope it does. Okay, but and hold on, I own some Bitcoin. Whatever 2% of my investments are, but would I be buying here as a trade if I were trading Bitcoin? No, because it's trading like crap, right? And I don't like to buy things that trade like crap. I like to buy things that are trading well, and I'm picking turns. So by definition, I'm buying things that have been trading like crap, but I buy them once they start to trade well. I need the market to tell me they're trading well first, right? Yeah. And this one is clearly not doing that at this point. I know you want to sit there and be like, oh, every time it goes down, it's just a better buy because I know it's going to 1 million. Well, you don't know that it's going to 1 million. It might go to 1 million. It might go to wherever, okay? But you don't know.
I always say that's the same as in poker where you can go all in on every hand and you're like the best poker player that ever lived until you lose that one hand. So that's the problem with the like never sell, we're only going higher. And like you said, maybe it does go that way. Anyone who's, if you've been long the market for 30, 40, 50 year, 100 years, it's the case. But that's the broad market on Bitcoin. Again, and not to be a Bitcoin bull or bear, because I don't really have like a strong interest in crypto personally, but just once you fall into that mentality, I feel of this has, cheaper is better because it's just more attractive. It's like you said, you're fighting the tape, and that's kind of like going all in. It's going to work every time. Every dip will bounce, and until it doesn't, and then you're kind of washed out. And that's where I think so many of people kind of run
As
into
a
that trouble.
trader, that's absolutely right. As an investor, maybe it's a different story. I would say doing that with the stock market is a winning combination.
Mm-hmm.
The more you buy, the more it goes down over time. It might take some time,
Mm-hmm.
but I would argue that's going to work.
Mm-hmm.
Okay. And people are like, oh, well, the NASDAQ crashed in 2000 and it took, 17 years or whatever it is to get it back. So you
Mm-hmm.
wasted 17 years. Yeah. If you put all your money in at the top and
Mm-hmm.
never invested again, it took 17 years. How long did it take if you were dollar cost averaging the whole way down?
Mm-hmm.
A hell of a lot less than 17 years, right?
Yeah.
So with the stock market, which is something that has proven over time, over very long periods of time, to have upward drift, and there's reasons that it has upward drift, right? I would say 3 of them: population growth, right?
Mm-hmm.
Companies have more people to sell stuff to, so they're going to get more revenues. If they're going to get more revenues, and over time, the value of their company is going to go up, right? Inflation is always going to be a thing. So if they're selling the same thing for $15 that they used to sell for $10, their revenues are going to go up, and therefore, over time, the value of their company is going to go up, right? And innovation, which is not going away. Right?
Right.
They're going to squeeze more profits out of their revenues because that's what capitalism forces you to do, right?
Well, if you look at just inflation, they say 2% a year. Maybe it's 2.5 is the real number, or whatever you want to call it. If that's 2.5, if productivity is 2.5, and you sprinkle on some population growth of 2 or 3%, I mean, you're pretty much getting exactly what the S&P 500's annual return's been for the past 100 years, right? That's pretty much what it is.
That's exactly what it is. That's all it is. I'm
Yeah.
a big believer that's all it is, and that's all it's ever been. Population growth, inflation, and productivity growth. That's all any of this ever has been.
Mm-hmm.
Okay. And unless that's going away, and some people will argue the population growth is going away, and maybe it is, but dollar cost averaging into stocks has over time been a pretty good thing. Could dollar cost averaging into Bitcoin be just as good or better? Maybe. I don't know. I don't know enough about Bitcoin to really say that I know that that's what's going to happen.
Mm-hmm.
But as a trader, and even with the stock market, okay, you could say that's how the stock market works. But as a trader, am I looking to trade long the stock market at this exact second, as it has traded like shit since Palantir? No, I'm not. Would I be more than willing to get long when it starts to trade better? Sure,
Mm-hmm.
But again, that's the point. Who cares about any of this crap? If it's trading well, you're long. If it's trading like crap, you're not, or you're short, right?
Well, I think that's where most people run into the problem. Whether it's my process, your process, whether it's dollar cost averaging into the SPY ETF, whatever it is. I think most people, there are those key mistakes you don't want to make in the market. Excessive leverage without any kind of timing or stops, or all the classic things. And the problem, I think, is most people don't have a lot of those, even the basics. They get into it. They like the idea of it. They hear someone made money doing it, and this stock's gonna be the next big thing, blah, blah, blah. And I think if people, like, at least even from this podcast, like week to week, get like one fundamental truth of like what you want to do to kind of improve to yourself, so that you don't fall into these traps, or at least whatever their strategy is for them, it works for them, but there's at least a logic behind it. Like, one thing I want to talk about, we spoke about the tape and all, it's a little more abstract, I think, for some to get at least. But one thing that I've always focused on, I think it applies to investors too, maybe just in a different way. But the idea of like, risk versus reward and asymmetry inside like your process. So for example, if I want to buy NVIDIA, like, I have to kind of look at what's my upside going to be versus my downside. So I have a very strict kind of process I'll run for that. I try and make it as objective as possible. And the whole point is, if you're going to be wrong, you got to make a heck of enough money when you're right, because you're going to be wrong. It's going to happen that way. Although a lot of people, I think, when they step in, they don't realize the risk they're putting on. How do you view that? Like, what's your process when you're putting it on? I know we spoke at the conference and you came down, you have like, fixed stop, but like, what's your view about asymmetry? Because I think what's really interesting about me and you, where you spoke about kind of your stats and all of that, where you say you're wrong more than you are right. I'm the same thing. And it's ironic because I'm a trend follower and you're like, trying to catch tops. But I think that's a reality of the market. It's very hard to just simply be right all the time. The guys are thinking I'm right eight out of 10 times. I find that hard to believe for most. So that's why for me, it's if you can be right, at least make more when you're right than when you're wrong. You build in a buffer in your system where, hey, if I'm going to be really wrong for 6 months, I'm not going to get blown away because somewhere I'll make some money. Like, what's your view on that in terms of a process, Jason?
That's all this is.
Mm-hmm.
I'm not talking about investing for the long term and, low cost, S&P tracker funds.
Mm.
I'm talking about trading. That's all trading is.
Yeah.
And that's what people don't understand.
Mm.
And it's unfortunate, frankly. I got out there in the last few years to try and push, if anything, that one message. People don't want to hear it. It's not a popular message. And that's fine. They hear it later after they blow out, and then they hear it. Hey, that guy Shapiro, maybe he wasn't that freaking crazy. All right. Of course, by then it's too late. That's the nature of life, and that's the nature of learning, and that's the nature of the beast. But that's all trading is. It's not about predicting the future, which you're not going to be able to do successfully over time because Nostradamus was not real. Okay. People do not predict the future. Nobody sees the future. All right. And particularly in the market, which is a discounting mechanism. Right. It's about trying to isolate opportunities where the potential payout is much more than the potential loss. And how you do that is up to you. Okay. There's a number of different people do it different ways. You do it a certain way. I do it a certain way that are very different. It doesn't matter. I mean, it matters, but that's what you have to be focusing on. Period. All right. I had this talk this weekend because I put it out there because I had been hearing from a lot of people who are having a real tough time in this market. And I put a thing out there like, hey, if you need, I've been there. I know what it's like. If you need someone to talk to, hit me up.
Yeah.
I'm more than happy to talk to you. Right.
I saw that. That was really genuinely nice because a lot of people need that. It's going to be a tough business.
A lot of people responded. So many, in fact, that first I was responding back to them one at a time. And then it just got to be so many that I was like, let's put a Zoom call together and I'll sort of look at all of the things that these people are telling me and I'll try to put some answers together that will fit everybody. And I did the Zoom call. And there was basically two out of all the responses that people were sending me, two, maybe three things that they were all doing, which was the same thing, right? And it's hard for me, and it's probably hard for you because I've been doing this a long time, to go back to before I was in the markets and think about what I thought. But in general, what we think when we haven't been involved in this, I go back to when I was in 10th grade. And there was this gym teacher, and apparently he had a whole bunch of money. And I can remember somebody saying, oh, he made like a ton of money in the stock market. He bought this stock and it's split. And, and I was like, wow, that's cool. That's exciting, and like, that's what you think the market is. It's this place to go and you get involved and you make a shitload of money. Right. And as we grow up and we get involved in it, we learn that that's really not what it is. Right. What the market is a casino, right? It's no different than a casino. If every time you replace the word I am getting involved in the market with I am going to the casino, then I think maybe you will be a little bit more realistic about your expectations. If every time you say I am trading, change it to say I am gambling, then maybe you'll be a little bit more realistic, right? People come in like, oh, I need to make a bunch of money, so I'm going to get involved in the markets. Okay.
Are you talking just like anyone who comes in without a process, or are you talking like for someone like you,
the market?
Even for yourself, you view it like every trade is a gamble, even though you have a systematic process?
It is a casino.
Okay.
Anyone who wants to argue with me that, you can argue all you want, and that's fine. And I'm not here to say everything I say is 100% right and all that stuff, but I'm telling you that that's all this is. This is a casino, and all you're doing is gambling. All right. And we can get into it in a second, but if someone came up to you and said, oh, I'm having some financial problems, so what I'm going to do is I'm going to take my money and I'm going to go to the casino because I need to get out of my financial problem, what would you say to them? You say, you're out of your freaking mind. That's all you would say. You're playing a losing game. All you're going to do is give money to the casino. That's all you're going to do. And the market is no different. Okay. But then how does anybody make money? Okay. You can make money at a casino. How? You count cards. If you learn how to count cards at the blackjack table, and you do it in a systematic way, and you do it in a way where you don't lose your head, right? And you keep it disciplined, understanding that even if you're counting cards, it doesn't mean that a card can't come up bad, right? Because it still can come up bad. So you're not going to bet everything just because the odds are in your favor, right? All counting cards does is put the odds slightly in your favor. So then you have to be systematic about it. And slowly you'll make $3, lose $1, make $3, lose $1, make $3, lose $1, and over time you'll make money. And so the casinos don't allow that. They're private companies, and they are allowed to tell you that you're not allowed to do that inside of our private company. Why do they do that? Because they don't want you to win money, clearly, right? The market can't do that. So if you want to make money in a casino of the market, you have to learn how to count cards. And once
But,
you learn how to
the
count
story I always
cards,
use, the one I always tell is that's why on the roulette table there's 0 and 00, because the house wants to make sure they have odds. Even each spin they don't know if they're going to win or lose. They just want to know after 100 spins we're going to be statistically we're going to make money. It's small. I mean, those two little numbers on the wheel that most people don't even pay attention to, but that makes all the difference over a longer period of time. So I think if you approach it from that perspective, that makes I think that's the right way to think about it, because if you have no plan, if you, like I would say, if you want to treat the market like a casino, it'll be a casino for you.
But it is a casino. There is no way to predict the future. Okay. It's a casino. The market is a discounting mechanism. Anything that you tell me or that I tell you is nothing that everybody else can't see. All right. It's not like, hey, this is a great company, so I'm going to buy the stock. Okay. No, no. There's a lot of great companies where the stock goes down because it's been over discounted, because that's what happens in the casino, right? You have to learn how to count cards. People are like, and I was getting a lot of these emails from people like, oh, I lose my discipline all the time and blah, blah, blah. I'm like, no, you don't. You're flipping coins. That's the problem. So to tell me that you're losing discipline is not the problem. The problem is you're flipping coins and paying VIG to the coin flipper every time. So you're making it, just like you say, the 00 comes up, right?
Yeah.
You're looking at people like, there's 37 numbers on a roulette wheel. So 37 people go to play the roulette wheel. Everybody puts their chips on a different number. One guy hits. So now that's the guy you're listening to on how to play roulette, right?
Yeah.
Go flip coins. 200 people flip a coin. 100 of them get heads. You take those 100 people, 50 of them get heads. You take those 50 people, 25 get heads. You take those 25 people, 12 get heads. Eventually you got one guy who got heads 10 times in a row. Is he the greatest heads flipper that ever lived? And you're going to buy his book, How I Can Teach You to Flip Heads Every Time? No, his chances were 50-50 every single time. And the next time he flips, it's going to be 50-50 as well. That's exactly how the market is. So you have to count cards. That's the only way to beat the casino. Okay.
I think also a part of that, though, is, again, it's the part nobody wants to learn about, but like the position sizing, the risk management side, which is, mixed up with portfolio management, that is so much a part of your edge as much as it is, let's say, research or when to buy and all the rest. Cause like, to your point, like whatever, even if you're counting cards, if you don't have a good position size, by that I mean, if I'm going all in on the next one because it's odds are stacked in my favor, you blow out, you don't get a chance to see the other cards.
That's right.
I think that's why so many people, even if they come to the market and they say I'm going to be disciplined. Well, discipline is not just about when to buy; it's how much to buy, how aggressively to buy, how many positions to put on, how much simultaneous.
Once you have a process that actually makes money over time,
right? Yeah, exactly. And even at that, if
you can go play blackjack,
and
be like, oh, well, I bet too big on this hand, and I bet too big on that hand, and I bet too small on the ones that I made, and I bet too big on the ones that I lost, blah, blah, blah. It doesn't matter. You sit at the blackjack table long enough, you're losing money because you're playing a losing game.
Yeah.
All right. Once you learn how to count cards, then those things that you're talking about become unbelievably important.
Well, I'm saying that you need both sides of that equation. Even if you can count the cards, if you don't have the other side, it still won't work. Like you really need that entire package. There's so many ways you can put it. Maybe people don't want to hear, but it's like if you're designing a card, you just think about acceleration. You won't do well when a corner shows up. Like you really, like, every part of it has to work together. And then you can have the possibility to kind of be the house instead of the player. That's the way I look at it.
Yes. But I'll say it all starts with learning how to count cards.
Yeah, 100%.
And there's a number of ways to do it. Look, people that buy breakouts, for example, that's their way of counting cards. The odds of a stock going up when it makes a new all-time high on a breakout increase. Time has shown that. And particularly if you're doing that in a bull market. So that means you have to figure out what is a bull market, right? And what is not a bull market. And then buy your breakouts. And that's probably a good way to count cards. And then you get into your risk management. Okay, I bought this breakout. The breakout failed. I'm getting out and taking my loss. Because as soon as you don't do that, the breakout fails and now the stock goes down and it goes all the way down and you lose all the money that you made on whatever the last 10 trades. That ain't going to work. So yes, that's to your point, right? You need to have that discipline. But the first thing you need to do is learn how to count cards. And I know people don't want to hear this. And I'm sorry that they don't want to hear it. But if I have learned anything, I'm 58. I started doing this at 21. Okay. If I've learned anything, I've read every book that you could imagine. I've worked for some very well-known, successful hedge funds and traders. Okay. I've done pretty well myself. I've worked with a lot of different people. If I have learned one thing, if you're going to trust me on anything, besides obviously my fashion sense, you should trust me on this. This is a casino, and all you're doing is gambling. Unless there's, like I say, there's two places. One, counting cards, because that's how you win at gambling. And two, taking advantage of the upward drift in the stock market, which you will have over time, right? That's the great thing about the stock market, right? It's the only market out there that has upward drift. You look at the cost of soybeans over the last 150 years,
Right.
there ain't no upward drift, right?
Right.
Look at the US dollar or the currencies. There's no upward drift, right? There's upward drift in the stock market. So you can take advantage of that. But that just means passively buying index funds, you know, and accepting the return that you're going to get over time, which is going to include some nasty drawdowns, which should be seen as opportunities to buy more. But those are the two places. And I would suggest for 99.999% of the people to do the latter, because you're not going to believe this. You're not going to want to believe it. But every piece of data in the history of mankind that deals with markets will prove it. That's going to beat you. It's going to beat you. Okay. Dollar cost averaging into a long in the stock market over the course of your lifetime is going to beat anything that you do trading. I'm sorry. It is.
Well, traders, like anything, operate by the power law. Like the really great traders take the lion's share of the profits. It's like in sports, you know, it's Ronaldo and Messi in soccer, or, you know, Aaron Judge and base. I mean, they make most of the money. And so it's, if you want to enter the ring, you got to want to be good. You're going to have to work at becoming a good card counter. If you're going to say, I'm going to go in there, I'm going to do it in my spare time, I'll spend 10 minutes a week. Like it's a hard way. You know, you're not working with odds in your favor. That's for sure. Yeah.
Not a chance in hell.
But
And
one
like
thing
I
I'll
say,
yeah.
know what it is that you're doing. Okay.
Mhm.
Messi is not practicing basketball to become a soccer player. He knows what he's doing. He's playing soccer. Know what it is that you're doing here. You're playing in a casino. Go read books on how to beat the casino. They're out there, and they all come down to really one way. There's really only one way to beat a casino, right? That I have seen, which is to count cards on the blackjack table. You're never going to beat a roulette wheel. Guys have tried, right? They've tried to calculate, you know, you're talking about MIT people, what the speed is of the roulette wheel spinning. And therefore, when they let go of the ball, what the chances are that it's going to finish on this side of the roulette wheel. And if you know that there's an 80% chance it's going to finish on this side of the roulette wheel, well, then you can bet that whole side and maybe make money. They've tried that. Hasn't worked, right? You might be able to make money in poker. You see the same poker players make money time and time again over time, right? And that's really the proof of any of this, right? Any one person can win at trading or anything else at any one time, right? Like I say, I can put my money on some number in roulette, and that number hits. Doesn't make me a great roulette player. It means that I was lucky that one time, right? Stick me in there 100 days in a row and let me win 80 of those days, and now maybe we can talk about that I'm a great roulette player. But that'll never happen because it is statistically impossible, right? Poker maybe, because you're playing against other people. So you can take their money. The house, they take their rake. But in general, you get enough bad players in there that if you play disciplined poker and you know what you're doing, then arguably you can make money playing poker as well. But again, it's the same 2 or 3% of the people that make money in the poker rooms. Everybody else is the fish, right? Because the fish are not playing the game. Whereas you read the successful poker player, read Annie Duke's books, right? She talks about these exact concepts, you know. You got to realize the game you're playing and play it that way. So anyway, that's my
So
soliloquy.
speaking of counting cards, so people can walk away from the podcast with something to watch next week. We're all looking for where the deck is stacked and where we're going to see a hot hand. What are you looking at right now? It's Monday. We're midday Monday here as we record this. What are you looking at right now? It's a top watch, something that has your attention. Does that have to be an entry here, but you think the odds are getting stacked? And what's your closest watch, Jason?
I'm watching the things that you were talking about, how to me, there's two things driving AI. So I'm watching how the market is reacting to any incoming AI type of news. like NVIDIA earnings, for example. And I'm watching the second thing that I think is driving the market, which is the liquidity thing. So I'm watching
Mhm,
how the market is acting to liquidity and liquidity news. We had news over the weekend that Japan is going to pump another $110 billion into their economy. That's
mhm,
positive liquidity. Well, the Nikkei went down.
mhm,
Bitcoin went down, right? So I continue to think that right now the market is just not it's just not trading well. So
mhm.
I don't think now's the time to be taking big risk on the long side.
Okay, no, that's fair. I see the same as you. I see things softening. Just in case things do improve, or there's some, some kind of the bearish sentiment would shift. Because I already have from right now, I'm kind of imagining what I have, but just keeping an eye on new things. There's speaking of kind of like the AI trade and the rest. There's a group that's been starting to see some strength that I've been watching. It's kind of like the specialty alloy stocks, which is interesting. So CRS is one. A lot of what they do is aerospace related, which aerospace has been strong all year. You could look at like GE Aerospace has been a great chart. Seems like persistent bid. So CRS is one I'm watching, even amidst all the wheat. And a part of their business is also specialty alloys for like the semiconductor business. So there's some tie overs. And you can also see within its group, if we take a look at ATI, which is kind of related, similar type of strength into recent new highs here. So these are a couple of stocks just within that group that I'm going to be watching closely. If strength returns, see how they kind of progress. And see if we can see some strength develop on the other side. So this is kind of, always looking to find some names outside of just those that are most heavily owned. And these have put in, good quarters, good responses. But what's most standing out to me is on this recent weakness of the Qs. Let's say take a look at triple Qs here. Qs topped October 29th, second top November 3rd, pushed lower. From that period here, from, the November 3rd market peak, we've been able to kind of climb. If you can climb in a bad tape, it depends how bad the tape gets, but there's something going on there. So that's something I'm going to be watching. We can kind of follow back next week and see how this is progressing here.
I mean, there it is, right? It's
Mhm.
exactly what you're doing. You're counting the cards, right? Exactly what you said, I think is exactly right. If the stock can trade good in a bad tape, does it guarantee it's going to keep going up? No,
Yeah.
but it increases the odds.
The market
I would argue.
improves, chances are more flow goes their way. So definitely something to
Yeah,
watch.
that's always
Yeah.
been how it is. Buying the strong, selling the weak, that type of thing. Eh, buying something that's going up when theoretically you wouldn't think it would be going up, right? If you're playing poker and you're playing a great poker player, let's say, and you've got this great hand and the board is whatever, that guy can figure out to a certain extent probably what you're playing. You're betting heavy because you've got some great hand and he's betting into you. You think
Mhm,
he's a freaking moron? Or you
mhm.
think he might have something that you're not thinking about, right?
Right.
Sometimes you got to fold a full house, right?
Mhm,
If I'm sitting on a full house and some incredible poker player who has had a lot of success is betting into me, I'm probably folding that full house. Now he could be bluffing me. I get that. But
mhm,
general over time, there's a reason. And it's the same thing here. There's probably a reason why these stocks are strong relative to the
mhm.
market here. That's what you want to be playing. That's what counting cards is.
Yeah, of
Does it guarantee? No. If the market completely falls out of bed, there's a pretty decent chance that those stocks probably go down.
course.
Okay, so you take your loss, you cut your loss, and you move on and you play it again the next time. You know, you play the next thing that's strong in the face of weakness, right? That's how we play this game. That's how
Yeah.
this game is played. Understand how the game is played first, and then you can talk about the rest of it.
All right, Jason. Well, it's been an awesome first podcast. And we'll have to end it here, or you and I are gonna end up going for 3 or 4 hours. But we'll
Yeah.
check back in with coffee next week, Nvidia, Google, CRS, and Bitcoin, and all the rest. Thanks so much, Jason, for joining me. And we'll be back next week with episode 2.
Awesome, man.